Next up, let's cover Robinhood margin. Investing on margin means that you are borrowing money from your broker in order to have more money to invest with. And the way this works is they will typically match you $1 for every dollar that you have invested in eligible assets that can be borrowed against. However, just like any other loan out there, you do have to pay interest on this loan, which currently starts off at 6.75% interest. And just like the APY on the cash sweep, these rates are subject to change. When you invest borrowed money, you're essentially magnifying the potential gain or loss that you'll experience. Let's say you had $1,000 in your Robinhood account and then you enabled margin and borrowed another $1,000 to invest with, giving you $2,000 total. And then let's say you put all of that into a stock, and then after their earnings report, that stock drops 25%. You would lose 25% of the $2,000 invested, which would actually be $500. And since you only had $1,000 of your own money in that account, that would actually be a 50% loss on your investment. More often than not, that's exactly how margin investing plays out, and you end up magnifying your losses versus magnifying your potential gains. And if your portfolio drops substantially in value when you have margin enabled, this can result in something called a margin call, which is where they can require you to deposit additional funds, and if you don't do this in a certain period of time, they can actually sell off whatever else you have in your portfolio to get the money that they lent you back. As I'm sure you can see now, margin investing is extremely risky. It is not recommended for most investors out there, but it is available in the Robinhood app if you want to explore this later on after better understanding those risks.